Hey guys, happy Sunday. Welcome back. I just want to start out by saying I truly value each and every one of you that are here to learn about finance, learn about investing, and learn how to value stocks. And I am sorry for the ones who are more engaged with the emotional stuff. We have to leave them behind. But for those of you who are my core audience, yesterday in Saturday's GameStop video, I went over some key concepts to help you understand how the market currently values GameStop's stock price. Yes, we all have our future speculative hopes for GameStop, but as we're trading it right now, as we're looking for ideal entries, it is crucial to understand how the market is valuing GameStop. And why do I think people don't understand that? Because I see it every day on Reddit. I see it every day on X. I hear it every day on YouTube. Why aren't they giving value to our stock? You keep asking the question, I'm going to keep trying to help. That's just what I do. Yesterday, we dove into profitability and financial efficiency ratios like the PE ratio, ROIC, ROE, and ROA, and why these ratios are far more important to GameStop's share price out there in the market than how much cash is on the balance sheet. I really don't want to see any comparisons of GameStop's cash to the current price and then tell me there's no debt. I mean, this is just ridiculous stuff that we're seeing out there on social media right now. Balance sheet has to do with liquidity and solvency. That's fine. To derive a share price, we need to focus on profitability and financial efficiency. Now, fair enough, we've seen a ton of improvement from GameStop and the management team driving changes and improvements over the last 4 years. However, is it enough to derive the share price that people want to see out there today? That's what we're going to talk about in this video. Using tools such as financial efficiency ratios give us a peek under the hood to see how well the company is turning money into profits and using its resources. Think that cash hoard that they have, $8.4 billion or so. Today, then, let's shift gears in this video and talk about the steps that GameStop's management can take or is actively taking, things that I'm excited about to boost the company's future valuation and take this stock to the next level. Now, we've all seen the wild price targets floating around out there on social media and YouTube. People giving you price targets of $50, $850. People drawing charts with arrows that go nothing but up and to the right. However, these type of charts and price target predictions are usually thrown out with no math to back them up. And that is a disservice to those of you out there on social media who are struggling to understand how to value GameStop, how to invest in GameStop, or how to swing trade GameStop, buy low, sell into run-ups. Those videos, those price targets, those charts are fun to watch. They're fun to look at, but they're mostly just speculation, not rooted in any financial reality. And the stock market is not a casino. It is full of sophisticated professionals, more and more every day, $4 billion worth of bond investors now in GameStop. These institutions use basic concepts of finance to figure out the company's fair value, and it is critical for you guys to understand how they are looking at it. So just to recap, what is fair value? We talked about it a bit a week ago or so whenever I did the discounted cash flow video for you guys to try and help you start understanding things like DCF. Fair value is an estimate of a stock's current worth based on expected future cash flows discounted back to today using a rate that reflects the cost of capital, like the WACC, the weighted average cost of capital that we talked about last week. If fair value is lower than the current stock price, you can expect that analysts might slap a sell rating on the stock. If fair value is higher than the current stock price, you'll see a buy rating. This is very binary decisions that these analysts are making. They run some computations using standard finance formulas. Higher or lower than fair value is a sell or a buy rating. For GameStop, the one analyst covering the company has set a 12-month price target of $14 based on his expected revenue and earnings trends. And that doesn't mean that we necessarily have to agree with him. He's just sharing his analysis based on him running the finance formulas and looking at the ratios. He may or may not be correct. Time will tell. We can all, as retail traders, have disagreement or debate with the analyst about their understanding of fair value, but you must kind of ask yourself, what is the market as a whole looking at? Because if a stock is trading above fair value in the market's view, it is likely to be shorted. Yes, stocks can be shorted, but they don't get shorted forever, because all of these professionals and institutions know what the fair value is, and at some point support comes in to push that price up. Nothing can be shorted to zero unless the company is just in absolute failure. We've seen a couple of those out there, but GameStop is not one of them. Plenty of liquidity, plenty of solvency at GameStop. The key is, with GameStop's price currently trading right around $22, $23, understanding how the market is calculating fair value is key to helping you understand or figure out where the price is likely to go. Now let's talk numbers for just 1 minute. I'm not going to bore you in this entire video talking about numbers, but there are a couple of key concepts that I want to continue to convey to you guys and encourage you to go read up on yourself. And we're going to talk about return on invested capital. That is really one of the most key ratios that GameStop needs to focus on improving, especially relative to its peers. According to stockanalysis.com, GameStop's trailing 12 months ROIC is under 1%, 0.84% to be precise. But here's the catch. If the weighted average cost of capital is around 11%, as we previously estimated in the DCF video, that means that GameStop is not earning enough on its invested capital to cover its costs. When ROIC is underneath the weighted average cost of capital, that is what we call destructive to value. I want you to look that up and do your own DD. Even if we use an average retail brick and mortar type business weighted average cost of capital of around 8% for GameStop, the 0.84% trailing 12 months ROIC of GameStop still falls way short. This is a red flag for professional and institutional investors, and it's why GameStop's valuation might not reflect its $8.4 billion cash hoard or recent improvements in profitability. To put this in perspective, let's compare GameStop to its competitors. And I've got a few of them that I'm going to put up on the screen here. We're mostly going to be talking about Best Buy because I want to focus on competitors that are in the retail sector. GameStop's trailing 12-month free cash flow margin is 11.81%. It's even better if you just look at the most recent quarter. But the thing is, that strong free cash flow margin of GameStop does not really reflect any operational efficiency. That improving free cash flow margin is coming from interest that the company is earning on its cash pile. And what the market is really more interested in is improvements in operational efficiency, not earning 4.5% on treasuries from cash. Now check this out. GameStop's ROE is 6.62%. The ROA is 0.72%. And ROIC, as we said a minute ago, is 0.84%. Compare that to Best Buy, which boasts 30.2%, 7.5%, and 15.62% respectively. ROIC, arguably the most critical ratio, shows the widest gap between the two, GameStop lagging far behind. And despite all of that solid efficiency at Best Buy, what is their forward PE ratio? 10.79. Hinting that GameStop's forward PE of 35 might signal an over-evaluation compared to its $22 current price out there in the market. Now, I know there are people out there that want you to look at something like a Palantir and say, if they can be highly valued on a PE ratio, why can't GameStop? Palantir has expectations of growing revenues and growing profits. And GameStop is not at that point right now. So we can't really compare GameStop's PE ratio to Palantir and say they should be valued at 250 PE ratio. That's not going to happen until things fundamentally change at GameStop. We need to continue to compare it to its local competitors in the retail, brick and mortar, specialty retail sector. So how can GameStop's management turn this around and boost valuation? What are they already doing? Here are some practical steps. They can, as I've said, invest the cash wisely. And Ryan already knows this. You guys probably know this too. It's one thing that we're all waiting on. While earning $90 million a quarter in interest is great for free cash flow and free cash flow margin, it's not driving operational growth. Management could instead take that cash and invest it in new revenue streams like expanding e-commerce, expanding gaming tech, or acquisitions to push that ROIC above the weighted average cost of capital. This would, in effect, change the valuation of GameStop out there in the market. A smart move like that could lift fair value by showing future cash flow potential. I know you want that valuation now, and maybe you're gambling on investing in GameStop's price, expecting that that is going to happen, and that's fine. No argument for me. But if you're asking why today that valuation is not there, it's because the cash is not invested yet. Maybe it will be. I hope it will be. I think it will be. The second thing that the management team can do is continue to improve operational efficiency. There's still room to cut costs or boost sales. And this is why management has been focused on closing underperforming stores, optimizing inventory levels, and improving the inventory mix to concentrate on higher margin items like the collectibles. All of these changes could lift operating income, which would raise ROIC and make the business more attractive to all investors, including these big institutions. Number 3 item that management could do, if reinvestment of that cash stalls, if they can't figure out what to do with the cash, they could use the cash for stock buybacks or a dividend. That is another way that they could improve the value to shareholders. Reducing the shares outstanding could boost earnings per share, while a dividend would signal confidence, both of these potentially increasing fair value calculation done out there in the market by professionals. The fourth and final thing that management could do is turn around the revenue growth. Right now, we're looking at about a 25% year-over-year revenue decline, and that makes continued to infinity margin growth very difficult. It's amazing work that the company has done so far, but that can't continue forever while revenue is falling. Management should keep pivoting to high margin products or partner with gaming platforms or PSA, whatever it takes to grow revenue, and that would drive higher cash flows and push the fair value above where the analysts are calculating it today. I have confidence in this management team. You guys know that if you've been watching my channel for a while. They've shown commitment to improving the financials over the last 4 years. Can they take it to the next level? If they pull this off, investors might see fair value rise maybe to $30 or $40. It depends on what ROIC gets improved to. Could we raise ROIC from under 1% to 8, 12, 15% like Best Buy? That's something I think that the management team definitely is focusing on. We need to wait and see if they can make it happen. What we're going to be watching for in this upcoming quarterly announcement in September and the other quarterly announcements that remain during this year is what happens with the revenue trend, what happens with operating margins, and will management give us any idea about what they plan to do with the cash? These are all telltale signs to keep your eyes watching for, keep your ears listening to management, because when we see these type of things changing, then I think you're going to see the fair value estimates for GameStop increase from analysts. As we're preparing now, we're waiting for the Q2 earnings results in September. Now is the time where every single one of us are sharpening our pencils, our own expectations for revenues and margins. There's going to be a wide variety of opinions out there. That's fine. I have no problem with anybody's opinion about estimates for revenues and margins. We'll all find out together in just a few short weeks. It'll be exciting to find out if the company continues to make needed improvements to drive for a higher valuation. Let me know what you think down in the comments below. Should GameStop go all in on PSA and grading cards, or should they focus on share buybacks and dividends? What do you think? Drop your ideas in the comments down below, and don't forget to like, subscribe, and hit that alert bell for more notifications as we continue the ongoing coverage of GameStop. I am Tony Denaro. Thank you for watching, and I will see you on the next video.